Hey, Andrew and Jim here with the Ultimate Lending Team and Guaranteed Rate Affinity. We've heard a lot of questions about assumable loans recently, so we are going to jump right in. And the very basics on an assumable loan means that the seller is willing to allow a new buyer to assume their existing loan and everything that goes along with it, the rate, the term, mortgage insurance, and everything else.
You literally get to take your name and put it on the seller's loan.
That's right.
Yeah.
Now, the caveats here is assumable loans are generally allowed on government loans like VA, FHA, and USDA, and they're almost never allowed on conventional loans. If you're not sure, or whoever you're working with is not sure if they have an assumable loan, you can look at page 4 on the closing disclosure. And right here, under additional information about this loan, there's a checkbox that says whether that loan is assumable or not. And then Jim, with pros and cons here.
Yeah, the obvious pro is that you get that lower interest rate that we've seen over the last few years. And that lower interest rate would also give you a lower monthly payment potentially. And also there will be less closing costs because you're not going to have to re-originate a new loan. You'll just be going through the process of assuming the old loan. Now, the cons are, and the first one and probably the biggest one is that you have to bring the remaining equity to closing. So if the purchase price, let's say, is $500,000 and the loan is $250,000, you would have to bring $250,000 to closing to make sure you could assume that loan. You can't bring another loan on top of that. Also, it might take a little bit longer to close because we're going to actually have to call the current loan servicer on that property and have you go through the credit qualifying process. And we're just not sure how long that might take. It depends on the bank and so forth. So it could take you a little bit longer to close.
Yeah. So at a very high level, to summarize, an assumable loan can be a really great option for a buyer because of that reduction in interest rate and monthly payment, with the caveat that they have to bring that additional equity. And this also goes for your listings. You know, if you have a listing that maybe needs some extra marketing or some extra visibility, talk to your seller and see what kind of loan they have on that property. If it's one of those government loans, and you double check that closing disclosure, you may be able to market that as an assumable loan and get some additional buyer interest on that property.
That'd be nice.
So that's the high level. We also have a case study here with a client of ours that we had been working with just last week. And they found a house that was listed for $550,000. And they had been, the first time home buyers. They have 5% down. And we looked at what it would look like for them to either assume this FHA loan or what we could do with a 2-1 buy down and a $13,000 seller concession.
Those are also popular right now.
That's
the
right.
2-1 buy downs.
That's right.
Yeah.
So in this case, the 2-1 buy down in the first year would save them almost $600 a month in their monthly payment. And they only needed $35,000 cash to close with the 2-1 buy down and their down payment and closing costs. Now we looked at the FHA assumption loan and wow, it was only at a 2.75% rate.
Well,
and even with the mortgage insurance, it was going to save them another $800 a month, even past the 2-1 buy down. So almost $1,500 a month less than the 7% rate. And that included the monthly mortgage insurance. Now, the one big downside, as we discussed, is that it drastically changed the cash they had to bring to closing. The assumable loan still had a $452,000 balance, and with the purchase price at $550,000, that meant they had to bring almost $100,000 in down payment, and with closing costs, it was $105,000, which ultimately they went the conventional route. But it could have been, it would have been really great had they had that access to additional cash for a down payment, as you mentioned.
They had to bring an extra $70,000 to close, and that didn't quite work out for them. But for other clients, it might work out. You might have a family member that wants to jump in and help with those savings. Because if you look at the orange bars on this case study, you'd save $110,000 over 5 years by bringing that extra amount. So the client might want to, talk to their family or maybe dip into some other cash accounts that they might have to get that savings. So it's still something that you'd really want to explore.
That's right. So in closing, FHA, VA, USDA loans as assumable loans can be a really, really great option, both for listings and for your buyers. And if you have any questions or you want to talk any more details, we're always here to help. And we look forward to chatting with you soon. Thank you.